ASC 205 Financial Statement Presentation, Section 5 of 5, Going Concern Assessment and Disclosure. Welcome back to The Explainer. Today, we're diving straight into the absolute bedrock assumption that sits beneath every single financial statement we've learned how to present. Just to give you a quick roadmap of where we are, we're kind of bridging a gap right now. In our last lesson, we focused on comparative periods and key presentation terms. In our next lesson, we're going to look at the worst-case scenario. What happens when a company actually shuts down? But right now, we're examining the critical health monitor that sits right in between those two extremes. Here's how we're going to break this all down today. First, the going concern assumption. Second, the trigger list. Third, evaluating doubt and plans. And finally, outcomes and required disclosures. Let's jump into Section 1, the going concern assumption, the baseline of financial health. We're going to treat this strict compliance requirement a bit like a medical diagnosis. You see, under US GAAP, every set of financial statements is built on one massive, underlying assumption, that our patient, the business, is healthy, that it's going to continue operating and paying its debts for the foreseeable future. This is the going concern assumption. And honestly, this is absolutely crucial. Why? Because it literally dictates the math. It means we value assets at their normal carrying amounts, not at some desperate fire sale price. It means liabilities are classified normally into current and non-current buckets based on standard payment terms. The whole framework rests on this being true. But, when it's seriously in doubt, the people using those statements have a legal right to know. Now, here's a really vital insider warning about when we actually check on this assumption. Management has to perform a formal going concern assessment at every single annual and every single interim reporting period. Please do not treat this as just some year-end checklist item to keep the auditors happy. If symptoms pop up mid-year, say in Q2, you absolutely cannot defer that to the annual assessment. You've got to evaluate it right then and there. Moving right along to Section 2, the trigger list, spotting the symptoms. So, at every period close, you have to review this specific list of conditions. We're looking for red flags, things like recurring operating losses, negative cash flows from operations, a working capital deficiency, which just means current liabilities are larger than current assets, or maybe defaulting on loan covenants. It also includes pending major legal actions, losing a massive customer or a key license, management actually declaring an intent to liquidate, or literally not being able to fund operations without taking extraordinary bailout measures. Now, here is the huge takeaway for you. This is not a multiple choice test where you need to fail 3 or 4 to trigger the next step. These are isolated signals. If our generic example, let's call them Company X, loses its primary manufacturing license, that one single symptom is enough to trigger a full assessment. You can't just brush it off because management optimistically thinks, hey, we'll be fine. Which brings us to Section 3, evaluating doubts and plans, diagnosis and treatment. Okay, so Step 2 requires us to look at those symptoms we just found and ask, do these conditions, taken together, raise substantial doubt about the entity's ability to continue as a going concern over the next 12 months? Basically, does Company X losing that license create a really significant question about paying their bills over the next year? If the answer is yes, we immediately move to Step 3, the treatment phase. We have to evaluate whether management's plans to address these issues are actually sufficient to alleviate that doubt. So can management fix it? And let me tell you, the rules for what actually counts as a treatment plan are incredibly strict. Management's plans must be probable of being effectively implemented within that 12-month window. And what does probable mean in GAAP land? It means concrete, hard evidence. Debt refinancing has to be backed by signed agreements, not just friendly chats with the bank. Equity issuances need committed financing arrangements. Asset disposals, you need binding sale agreements. Cost reductions have to be actual, implemented actions. You absolutely cannot use aspirational plans, hopes, optimistic financial projections, or ideas that are still waiting for board approval. They literally do not count as mitigating evidence. All right, Section 4, outcomes and required disclosures, the final prognosis. When it's time to write up the patient's chart notes, so to speak, there are exactly 3 scenarios and required actions. First outcome, conditions exist, but they just don't rise to the level of substantial doubt. The required action? Well, no disclosure is needed in the financials, but you absolutely must keep internal documentation of your assessment. Second outcome, substantial doubt does exist, but management's concrete plans are probable of alleviating it. In this case, you have to formally disclose the conditions, the initial doubt, and the plans using very standard language. And the third most severe outcome, Substantial doubt exists, and management's plans are just not sufficient to fix it. Here, you must make a very explicit disclosure. Embrace yourself because this is highly likely to trigger a severe going concern opinion from your auditor. Let's look at the actual language required, because this is super important. When substantial doubt is alleviated by management's plans, your footnote needs to look pretty much exactly like this. It clearly states the conditions raise substantial doubt, describes the implemented plans, and explicitly says management believes these plans are probable of being effectively implemented and will alleviate the doubt within 12 months. The crucial point to take away here is that this exact verbiage is a strict legal requirement. It's not a creative writing exercise, okay? You have to hit these exact notes. Now, if the doubt is not alleviated, the language becomes even more stark. You have to state that conditions raise substantial doubt about the ability to continue as a going concern. You describe the plans, sure, but you have to conclude with this exact phrase. However, there is no assurance that these plans will be effectively implemented. You must strictly use the phrases substantial doubt and continue as a going concern. If you just write a little note describing some tough business conditions without using this specific language, it completely fails the disclosure requirement, and trust me, it will be immediately flagged by the auditors. So this brings us to a really compelling final question. We've assessed the health, we've spotted the symptoms, and we've issued the disclosures for a company that's struggling to survive. But what happens if the business simply cannot survive the prognosis, and they decide to just close their doors entirely? If the assumption of a going concern completely shatters, you're going to need to know exactly how to report that new reality. And honestly, that is exactly what we're going to uncover in our next explainer on discontinued operations and liquidation basis. See you then.